Hello class, this is Sung Min, and I'll be presenting about overall assessment of the firm. So we've so far talked about some of the competitors of the firm, being Samsung, LG Corporation, Panasonic, and Sony. However, these firms are really big firms compared to Technicolor. They do have more sectors that Technicolor does not have focus on. So these are not really good firms to compare. So I do have three firms here that could be compared for this presentation. So if you take a look at the sales of Technicolor, obviously you could, from the diagram you see these uh, their sales has been going down so far since 2004. Actually, their sales has been going down even more beyond 2004. However, I have not included here. 2004, their sales revenue was at 8 billion euros, whereas 2009 is less than 4 billion euros. So it's up more than 50% decline in sales revenue in 5 years. If you take a look at the sales growth rate um, of comparable companies that I had in earlier slides, um, Leg, uh, Legrand SA, SB SA, Elstrom SA um, are doing better in relatively speaking. Also, although some of them are at negative sales growth rate. However, relatively speaking, they are doing better. Also, if you take a look at the stock performance and ratios, their stock price has been doing pretty similar things as what their revenue has been doing. And in 2000, their stock value was at 652 euros per share, whereas in 2010 we had Technicolor share go down as low as 0.46 euros per share. So this is a very big difference in 10 years so far. If you take a look at the key ratios, PE ratio, which is financial ratio, just means that how much investors are willing to pay. Kind of shows how shows the demand of the investor for the stock and for the firm. And Technicolor's PE ratio stands at 0.04, whereas all other comparable companies PE ratio is at a lot higher PE ratio than the Technicolor. Also, price per sales ratio kind of the same along the line. Interesting fact: in management of Technicolor only owns about 2% of their common outstanding shares, which kind of tells and which kind of shows what management of the firm thinks of the firm and thinks of Technicolor, of their future. And also, they have not paid dividend since 2007, whereas all comparable companies has paid out dividend in the last 12 months. So also some interesting financial position they are in. Their current liabilities is actually greater than current assets, so they will have problem with expanding, especially because they don't have resources to do so. Also, they have negative common equity, a share of equity value. Just means that your share has essentially no equity value, meaning that it means zero, whether you have a share or not. So far, based on what I talked about, you guys probably could guess, analyst recommendation has been reduced, and it kind of aligns with the information that I have so far presented to you guys. If you look at the sales revenue, some of the key ratios to comparable companies has shown that it's not really in the best time to go out and buy the shares of the firm. However, notable point is that their third quarter earnings in 2010 has beat the expectation of the analysts. So it is something to look out for. This is all I had for you guys today, and thanks for having me in this kind of manner. And back to class. Thank you.